We use Walt Disney, Time Warner Incorporated, CBS, Discovery, and Fox. The 5 technology companies that we used are Intel, Oracle, Alphabet Incorporated, also known as Google, Qualcomm, and Xerox. And the 5 companies that we use for the pharmaceutical industry are Merck Incorporated, Pfizer, Johnson & Johnson, Bristol Myers Squibb, and Cardinal Health. All right, financial analysis of these companies. We're going to do a short-term solvency, a long-term solvency, asset management, profitability, DuPont analysis, market value, and we're going to look at other measures as well. All right, first industry. We're going to start with the entertainment industry. Walt, Time, CBS, Discovery, and Fox. Here's a brief description of these companies. All right, short-term solvency. In analyzing and examining the short-term solvency, there's three liquidity ratios that will be examined. The current ratio, the quick ratio, and the cash ratio. Here's the current cash and quick ratio for the entertainment industry of each company. And here's their numbers from 2012 to 2016 over that 5-year period. All right, current ratio. The current ratio shows that the company's ability to pay a short-term obligation. Generally, the higher the ratio, the better able the company is to pay short-term debts. Fox has consistently had the highest current ratio over a 5-year period from 2012 to 2016. Fox's 2016 current ratio shows a ratio of 2.25. It has $2.25 of current assets for every dollar of current liability. Fox is in good position to meet its short-term obligations. Discovery had the second highest current ratio in 2016. Discovery's current ratio dropped below 1 actually in 2014, but rebounded to post current ratios of 1.644 in 2015 and 1.665 in 2016. CBS had the third best current ratio. CBS's current ratio has actually increased for 4 straight years. Disney consistently had the lowest current ratio actually. Disney's 2016 and 17 ratios, Disney's 2016 ratio of 1.007 is barely above 1. Disney's current ratio has slowly declined over the last 4 years. All right, we're also going to analyze quick ratio. The quick ratio shows the firm's ability to meet its current liabilities with its most liquid assets. These are assets that can be quickly liquidated. Fox has the highest quick ratio. Fox's quick ratio in 2016 was actually 1.74. Fox has had the highest quick ratio amongst the 5 companies actually each of the last 3 years. Discovery has had the second highest quick ratio though. The 2016 quick ratio for Discovery was 1.149. Discovery has consistently had a good quick ratio except for the year of 2014. Time Warner and CBS both had quick ratios above 1. CBS's ratio has actually been increasing over the last 5 years. Time Warner's has fluctuated a little bit. And Disney's quick ratio is actually consistently below 1 over the last 5 years. For example, in 2016, Disney's quick ratio was 0.7759. All right, the cash ratio compares the company's ability in cash equivalents with current liabilities. All right, it shows how much of a company's short-term debts it could immediately pay off without having to liquidate any assets. In 2016, Fox had a cash ratio of 0.8514. This was the highest amongst the companies in 2016. Fox had the highest cash ratio amongst the 5 companies in each of the last 3 years actually. Discovery and Disney's 2016 cash ratios were 0.1921 and 0.2737 respectively. The 2016 cash ratio for CBS was 0.1612 and it was 0.1586 for Time Warner. Time Warner's cash ratio is actually decreased over the last 5 years. All right, so in conclusion, Fox had the best liquidity ratios, Fox had the highest current ratio, highest quick ratio, and highest cash ratio in 2016. Fox also has consistently had the highest current ratio over a 5-year period from 2012 to 2016. Fox has had the highest quick ratio amongst 5 companies for each of the last 3 years. Fox has had the highest cash ratios amongst the 5 companies in each of the last 3 years. Fox is the best for short-term solvency position. Long-term solvency. Now in long-term solvency, we're going to analyzing the following ratios: the financial leverage ratio and the cash coverage ratio, EBITDA divided by interest expense. All right, here is the long-term solvency. We got the financial leverage and the EBITDA to interest expense for each of the 5 entertainment companies right here. All right, the financial leverage ratio compares average assets to average equity. A higher financial leverage ratio generally indicates that the company is using more debt to finance its assets. A lower ratio means the company is using less debt to fund its assets. Disney consistently had the lowest financial leverage ratio. Disney's 2016 financial leverage ratio was 2.052. Disney has also had the lowest financial leverage ratio for each of the last 5 years. Disney is using less debt to finance its assets as compared to the other companies. Time Warner and Fox were second and third lowest respectively. Fox's financial leverage ratio has been consistent over the 5-year period. Comparatively, Time Warner's financial leverage has increased over the last 5 years, and Discovery had a 2016 financial leverage ratio actually higher than Time Warner or Fox. Cash coverage ratio. This is the EBITDA to interest expense ratio. Indicates a company's ability to meet its interest expense. Generally, a higher ratio shows stronger cash flow, and that of the company is better able to meet its interest expenses. Disney has by far had the highest EBITDA to interest expense ratio. In 2016, Disney's cash coverage ratio was 47.257. Disney was in great cash flow position to cover its interest expenses. Disney consistently had a ratio above 30 in each of the last 4 years actually. No other company didn't even approach Disney in this category. The rest of the companies all had EBITDA to interest ratios between 5.6 to 7 for 2016. CBS had the second highest EBITDA to interest ratio, which was a ratio of 6.92. CBS also consistently had a ratio above 7 each year in the 5-year period from 2012 to 2016. Discovery's EBITDA to interest expense ratio has been consistent over time. Time Warner had a 2016 cash coverage ratio of 5.919. Fox had the lowest 2016 cash coverage ratio at 5.62, but its cash coverage ratio has been consistent over the past 5 years. Conclusion for long-term solvency. The company with the strongest long-term solvency position was clearly Disney. Disney also had the lowest financial leverage ratio for each of the last 5 years. Disney has by far the highest EBITDA to expense ratio. And in 2016, Disney's cash coverage ratio was 47.257. Disney was in great cash flow position to cover its interest expenses. Time Warner and Fox were the second and third best situated company respectively. All right, asset management in the entertainment industry. Here's the numbers for the asset turnover year by year in the for each entertainment industry. Asset management. The asset turnover ratio shows how efficient a company is in using its asset to generate sales. The asset turnover ratio is a good indicator of asset management. The company that has consistently over time had the best asset to turnover ratio is Disney. Disney's 2016 asset to turnover ratio was 0.617, the highest asset to turnover ratio of any company in 2016 of these. And Disney has also had the highest asset to turnover ratio in each of the last 3 years, actually. The companies with the next highest in 2016 for asset turnover ratios were Fox at 0.5762 and CBS at 0.5485. The 2016 ratios for Time Warner and Discovery were 0.4516 and 0.4109 respectively. The 2016 ratios for each of the 5 companies were consistent with the past performance for all companies over the last 5 years, except for Fox, which saw its ratio vary more from 2012 to 2013, but which has been consistent over the past 3 years. Disney has clearly had the best asset management. All right, profitability, profit margin, ROE, ROA, we're going to do a DuPont analysis. Okay, here are the numbers for everything. As you see, we got return on common equity, return on asset, and profit margin for the 5 companies we're currently looking at. Here's the numbers. All right, profit margin. This ratio shows how much income the company gets from its sales. It's a good measure of efficiency. Generally, the higher the net income per dollar in sales, the more efficient the company. Discovery and Disney had the highest profit margins in 2016. Discovery had a 2016 profit margin of 18.27, and Disney's profit margin was 16.88. Disney's profit margin has been steadily growing each year since 2012. Discovery's profit margin has declined from 21.06 in 2012 to 16.17 in 2015, but bumped up in 2016 to 18.37. Time Warner had a profit margin of 13.39 in 2016. Its profit margin has been steady since 2013, actually. And in 2016, Fox had a profit margin of 10.35 and CBS had a profit margin of 9.57. Fox and CBS have had profit margins vary from year to year. Return on equity. It shows how much the investor is earning per dollar of investment. It is especially important to measure to shareholders. It's an especially important measure to shareholders. The return on equity shows the amount of net income per dollar of equity. ROE is an important measure for shareholders. CBS had the highest ROE in 2016 with that of 27.26. CBS has had an erratic ROE, but the ROE has exceeded 15 each year since 2012. Disney's ROE was actually 21.39. Disney's ROE has consistently grown since 2013. Fox had a 2016 ROE of 20.09, but overall ROE has declined since 2012. Time Warner and Discovery had lower ROEs of 16.37 and 14.87, respectively, and Time Warner's ROE has been trending upward actually over the last five years. Return on asset. This ratio looks at how well management has used the company assets. Disney has had the highest ROA of any of the 5 companies. Disney's 2016 ROA was 10.42. Disney's ROA has steadily grown since 2012. In 2012, Disney had return on assets of 7.72, which grew to 9.07. 2014 went to 9.07 in 2014, 9.72 in 2015. Discovery had the second highest return on assets in 2016 at 7.55. Discovery's return on assets has been pretty steady over the last 5 years. Time Warner and Fox had similar return on assets at 6.04 and 5.96. One concern for Fox is that its ROA has been erratic and it dropped significantly from an ROA of 15.84 in 14 to down to 5.97 in 16. CBS has had an erratic ROA, dropping from 2014 of 11.76. In 2016, it was down to 5.2, which actually is the lowest ROA in the group. All right, here's the DuPont analysis for the 5 companies. All right, CBS had an ROE of 35.95 in 2016. CBS's ROE has grown since 2011. CBS has been increasing its debt over the past 5 years. The financial leverage ratio for CBS rose from 2.61 in 2013 to 5.188 in 2016. CBS is using more debt to finance its assets than any other company. Most of the increases in CBS's ROE are attributed to its increased use of financial leverage. CBS tax burden has increased. CBS tax burden ratio varies a lot from year to year. Fox had an ROE of 24.38, the second highest 2016 ROE. Fox also had a high leverage ratio, reflecting its greater use of debt to finance its assets. Fox had the second lowest tax burden of any company. Fox's asset turnover ratio is generally higher than the other company except Disney. Fox's ROE is attributed to its favorable asset turnover efficiency and its higher use of financial leverage. All right, here we're going to, a little bit of the DuPont continued. Disney had a 2016 ROE of 21.36. Its ROE has steadily grown since 2011. Disney has seen steady growth in its financial leverage ratio and its asset to turnover ratio. Disney's operating margin has also steadily grown. Thus, Disney's ROE increases, I think, are primarily due to an increase in financial leverage and an improvement in asset efficiency and just an improvement in operation efficiency. Time Warner had an ROE of 19.17, which was the 4th highest ROE. It has a higher financial leverage ratio than Disney, but lower than the other 3 companies. It had higher interest burden than other companies. Discovery had the lowest ROE. Market value measures. The following financial ratios and information will be used to analyze the market value of the company. As you see, we're going to use the price to earnings ratio, the price to book ratio, enterprise value over EBITDA, and the economic value added, EVA. All right, here's the numbers for the market value of the entertainment industry. All right, here's the price to earnings ratio. The price to earnings ratio shows investors' willingness to pay per dollar of earnings. A higher PE ratio means the company could have a good future growth. CBS had a PE ratio of 17.15. Its PE ratio has varied a lot over the past 5 years. Time Warner's PE was 16.63. Time Warner's PE has also varied a lot over the past 5 years. Disney had a PE ratio of 16.23. Disney's PE ratio has actually declined since 2013. Fox and Discovery PE ratios were lower in 2016 at 14.47 and 13.49 respectively. Fox's PE ratio has declined since 2012. Discovery's PE ratio is less than half what it was in 2013. Price to book ratio. This ratio looks at the market value of a firm's investment relative to historical costs. CBS has had the highest price to book ratio in 2016 at 7.1. CBS's price to book ratio has steadily grown since 2010 from a ratio of 2.34 in 2012 to 7.1 in 2016. This is by far the highest price to book ratio of the 5 companies. Disney had the second highest at 3.43. Disney's price to book ratio has generally been trending upward over the past 5 years. Disney had the lowest ratio at 2.8. Discovery had the lowest ratio. Discovery actually had the lowest ratio at 2.88. Discovery's price-to-book ratio is more erratic over the past 5 years. Fox's price-to-book ratio has declined steadily over the past 5 years. Time Warner had the second lowest 2016 price-to-book ratio. But Time Warner's price-to-book ratio has been trending upwards. EV over EBITDA. All right, Fox had the lowest 2016 EV over EBITDA ratio of 9.87. Fox's EV over EBITDA ratio has declined over the last 5 years. 2016, Disney had the second lowest EV over EBITDA ratio at 10.09. Discovery had a 2016 ratio of 10.24. Discovery's EV over EBITDA ratio has also declined over the last 4 years. Time Warner had a ratio of 11.83. CBS had a ratio of 12.705. The ratios for CBS and Time Warner have fluctuated over the last 5 years. Economic value added. The economic value added examines the economic profit of the company. Economic value added is a good indicator of performance. The higher the EVA, the better. The company with the largest dollar in EVA added was Time Warner at $2.778 billion. Time Warner's economic value added has steadily grown over the past 5 years. Disney's was second highest in 2016 for EVA at $2.143 billion. Disney's EVA has steadily grown over the past 3 years. Fox had the third highest EVA at $1.175 billion. Fox's EVA was significantly lower than the 2015. Its 2016 economic value added was significantly lower than the one it had in 2015. CBS had $923 million, and Discovery had $278 million of EVA in 2016. Now here's some other measures we're using: the price to free cash flow and the free cash flow. All right, price to free cash flow. Price to free cash flow compares the market value per share to its free cash flow. Disney had 17.92, Time Warner 17.73, CBS 18.97. They had comparable 2016 price to free cash flow. But Fox's was 5.41 and Discovery's was 8.55. Those are a little lower. Disney's ratio has generally been in the decline. Discovery's ratio has steadily decreased also over the last 5 years. CBS and Time Warner have had more erratic ratio numbers over the past 5 years, and Fox's ratio has been steadily decreasing over the past 4 years. Free cash flow. Free cash flow shows the money a company has after paying for capital expenditures. Disney had the highest free cash flow by far. Disney had a free cash flow of $8.44 billion. Disney's free cash flow has steadily grown over the past 5 years. Disney also had the highest free cash flow amount in each of the past 5 years. Disney's 2016 free cash flow was nearly twice that of Time Warner, which had a free cash flow of $4.251 billion. Time Warner's free cash flow has steadily been rising over the past 5 years. Fox had the third highest 2016 free cash flow at $3.408 billion. Fox's free cash flow amounts have been more erratic over the past 5 years. CBS had 2016 free cash flow of $1.489 billion, and Discovery had $1.285 billion free cash flow also in 2016. Supply chain. None of these companies were dependent on any one supplier or buyer in the supply chain. The highest revenue percentage paid to any supplier by any of the 5 companies was Disney, paying 2.47% to Brocade Communication, and that was a capital expenditure. The highest percentage of revenue received by any of the companies was CBS, which received 3.94% of its revenue from AT&T. All right, top company of the entertainment industry. I think Disney's the top company. Disney's had a good overall financial performance. It had the lowest financial leverage ratio in each of the last 5 years. Disney is using less debt to finance its asset as compared to other companies. Disney's 2016 asset to turnover ratio, which was 0.617, was the highest amongst the 5 companies. Disney has good asset management. Disney has had the highest asset to turnover ratio in each of the last 3 years. 2016, the cash coverage ratio was 47.257, and it was in great cash flow position to cover its interest expenses. No other company was close to Disney in this category. Profit margin is a good measure of efficiency, and Disney had high profit margins in 2016. Disney's profit margin has been steadily growing each of the last 5 years from 2012 to 2016 as well. And Disney had a 2016 ROE of 21.39. Disney's ROE has consistently grown since 2013. Disney had the highest ROA of any of the 5 companies in 2016. Its ROA was 10.42. Disney's ROA has also been steadily growing since 2012. Disney had the second highest 2016 price to book ratio at 3.43. Disney's 2016 EVA was the second highest at 2.143 billion. Since 2013, Disney has had strong economic value added, and Disney had the highest free cash flow. 2016, the free cash flow was 8.44 billion. Its free cash flow has also been steadily growing over the past 5 years. It's had the highest free cash flow amount in each of the past 5 years, actually. All right, on to the technology industry. We got Intel, we got Oracle, Google, Qualcomm, and Xerox. All right, here's a little description for you all of these companies. All right, short-term solvency. We're going to use the current, the quick, the cash ratio, just like we did for the entertainment industry. All right, and here are the numbers for the current cash and quick ratio of Intel, Oracle, Google, Qualcomm, and Xerox over the 5-year period from 12 to 16. All right, current ratio. Google's had the highest current ratio. Google's 2016 current ratio was 6.29, which is by far the largest current ratio of the 5 companies. Google is in a very good position to pay short-term debts. In the 5-year period from 12 to 2016, Google's short-term debt ratio has increased every year from a current ratio of 4.21 in 2012 to 2016, current ratio of 6.29. The 2 companies with the next highest current ratios were Qualcomm at 3.99 and Oracle at 3.08. Both companies had current ratios consistently above 3.0 in each of the 5 years also from 2012 to 2016, but Intel and Xerox both had current ratios below 1.75 in 2016. The quick ratio excludes inventory from current assets, thus indicates it has a high level of liquid assets available to pay its current liabilities. Google also had the highest quick ratio. Google's 2016 quick ratio was 5.99, showing it was in very good position to cover its short-term obligations. Google's quick ratio has steadily grown also from 2012, when it had a ratio of 3.9, to 2016, when it jumped up to a ratio of 5.99. Qualcomm had a 2016 quick ratio of 3.74. Oracle, 2.95, had the next 2 highest ratios. Both companies consistently posted good quick ratios over the past 5 years. Intel's quick ratio was 1.07, and Xerox's quick ratio was below 1 for each of the last 3 years from 14 through 16. Cash ratio. Google had a 2016 cash ratio of 5.15, showing it was in strong position to pay its short-term debts. Google had the highest cash ratio of any company in each of the last 5 years. Google's cash ratio has been trending upward over the last 5 years. Qualcomm, 2016 cash ratio had a cash ratio of 3.42. Oracle's was 2.73, and they are second and third highest for cash ratios. The cash and cash equivalents for the two companies will exceed their respective and short-term obligations. Qualcomm and Oracle cash ratios over the last 5 years are consistent with their 2016 cash ratio number. Intel's cash ratio was below 1 though in 2016, and Xerox's cash ratio has been well below 1 in each of the last 5 years. Conclusion: liquidity ratios. Google's had the best liquidity ratio of any of the 5 companies. Google had the highest current ratio, highest quick ratio, and highest cash ratio of any company in each of the last 5 years. Google's short-term ratio increased every year from a current ratio from 2012 to 2016. Google's quick ratio has grown each year from 2012 to 2016. Google's cash ratio has also been trending upwards over the last 5 years. And Qualcomm and Oracle had the next best short-term solvency positions. All right, long-term solvency. We're going to do financial leverage ratio and the cash coverage ratio again. All right, here are the numbers for each of the companies: the EBITDA to interest expense and the financial leverage. All right. Google has had the lowest 2016 financial leverage ratio. It's using less debt to fund its assets than other companies. Google's 2016 financial leverage ratio is 1.21. Google's financial leverage ratio has been consistent over the last 5 years. Google's financial leverage ratio has been in the 1.21 to 1.28 range for each of the last 5 years. Google also had the lowest financial leverage ratio of any of the 5 companies over the last 5 years. Qualcomm posted a ratio in 2016 of 1.88, and Intel had 1.66. Had the next lowest. Those had the next lowest financial leverage ratios. The financial leverage ratio has been consistent for both companies over the last 5 years. Oracle has had the second highest financial leverage ratio in each of the last 5 years. Xerox, with the highest financial leverage ratio of 3.25, is using more debt to finance its assets. Xerox has consistently had the highest financial leverage ratio actually over the last 5 years. All right, here's our EBITDA to expense. Google clearly had the highest EBITDA to expense ratio in 2016, and Google's cash coverage ratio was 240.8. It could easily meet its interest expense. Google consistently had the highest cash coverage ratio of any of the 5 companies over the last 5 years. Google's cash coverage ratio has generally been trending upward over the last 5 years. Intel had the second highest cash coverage ratio for 2016 at 28.19. However, Intel's cash coverage ratio has been decreasing significantly over the last 5 years. Oracle's cash coverage ratio in 2016 was 8.43. Cash coverage ratio for Oracle has also decreased over the last 5 years. Qualcomm cash coverage ratio has also decreased over the last 5 years. In 2016, it posted a ratio of 8.24, Xerox being the lowest of the 5 at 4.3, and it has also been decreasing over the last 5 years. Conclusion. All right, Google had the best long-term solvency position out of all of the companies. Google had the lowest 2016 financial leverage ratio. It's using less debt to fund its assets than other company. Google's financial leverage ratio has been very consistent over the last 5 years. Google has also had the lowest financial leverage ratio of any of the 5 companies over the last 5 years. Google clearly had the highest 2016 EBITDA to expense ratio. In 2016, Google's cash coverage was 240.8. Google consistently had the highest cash coverage ratio of any of the 5 companies over the last 5 years. Google's cash coverage ratio has generally been trending upwards also for the last 5 years. And here's the asset management, looking at the asset turnover for the 5 companies. There's the numbers. All right, asset management. Google had a 2016 asset turnover ratio of 0.5732, the highest of 2016 among the 5 companies. Google has had a very consistent asset turnover ratio. For example, the 2012 ratio for Google was 0.5812. Google is good at using its assets to generate sales. Google's asset to turnover ratio has been consistent over the past 4 years. The second highest 2016 ratio was Intel at 0.5529. However, Intel's asset efficiency has declined over the past 5 years. Xerox has had the third highest 2016 asset to turnover ratio at 0.4921. However, Xerox's asset to efficiency has significantly declined over the last 5 years, raising concern with the reason. Xerox had an asset turnover ratio of 0.7729 in 2012, which declined to 0.4931 by 2016. Oracle's asset to turnover ratio has declined over the past 5 years as well. The ratio of 0.56 in 2012, but down to 0.37 in 2016. Oracle has also seen its asset to turnover ratio just decline over the past 5 years, and it was the lowest of the 5 companies that we looked at 0.3052. Profitability, going to use the same stuff we used for the first 5 y'all saw: profit margin, ROE, ROA, the DuPont. All right, here we go. ROE, ROA, and our profit margin for each of the 5 for the technology industry. There's the numbers. All right, Oracle had a 2016 profit margin of 24.74, followed by Google with a profit margin of 21.57. Google and Oracle have been operating efficiently, and the profit margin for Google has been consistent over the last 5 years. Oracle profit margin has been trending downward though. The profit margin for Oracle has generally been declining over the past 5 years. Qualcomm had a 11.06 profit margin in 2016. Its profit margin actually declined significantly in 2016. Intel had a 2016 margin of 9.6. Intel's margin has also generally declined over the last 5 years. And Xerox had a negative profit margin in 2016. Return on equity. Oracle had the highest 2016 ROE at 18.46, followed by Qualcomm at 18.05. Qualcomm's ROE has declined over the last 5 years, growing from 20.2 in 2012 to 18.05 in 2016. Oracle's ROE dropped from an ROE of 24.74 in 2012 to 18.46 in 2016. Intel and Google's ROE are at 15.98 and 15.02 for each of those two. Google has had a consistent ROE over the past 5 years. Intel has been declining in ROE, and Xerox has had a negative ROE. ROA, the return on assets. Google's had the second highest ROA. Google's management has been efficient in using its assets to generate earnings. The ROA in 2016 for Google was actually 12.36. It's been pretty consistent over the last 5 years. The next highest ROA was Intel at 9.6. Intel's ROA has varied though over the past 5 years. Oracle's 2016 ROA of 7.55. Its ROA has been declining each of the last 5 years. Qualcomm had the ROA at 4.18, and it has also been trending downwards with its ROA. Qualcomm's 2015 ROA was 11.06, but dropped to 4.18 in 2016, and Xerox had a negative ROA for 2016. Here's the DuPont numbers and analysis for each of the technology industry companies. each of the companies we're using from the technology industry: Intel, Oracle, Google, Qualcomm, and Xerox. There's all the numbers. All right, Oracle had the highest ROE. Its 2016 adjusted ROE was at 19.18. It had the second highest financial leverage ratio as well, and Oracle also as well had the highest operating margin. Oracle has a tax burden which is comparable with the other companies except Xerox, which has a high tax burden. Oracle's high adjusted ROE is attributed to its operating efficiency and its financial leverage. Qualcomm had the second highest adjusted ROE at 19.09 in 2016. Qualcomm's financial leverage has increased over the last 5 years. Qualcomm had a comparatively higher ROE. I think it's due to the higher financial leverage. Qualcomm had the lowest asset turnover ratio. Qualcomm's operating margin has declined over the last 5 years. Qualcomm's ROE has also been steadily declining over the past 5 years. And then we're going to continue on it. Intel and Google have 2016 ROEs of 17.98 and 15.16 respectively. Google had the lowest 2016 financial leverage ratio of the 5 companies. Google had the lowest financial leverage ratio in each of the last 5 years. Google has the lowest 2016 interest burden of the 5 companies as well. Google has the second highest operating margin and the highest asset turnover. Google's ROE is attributed to its operating efficiency and its asset use efficiency and its low interest burden. Intel had a higher financial leverage ratio than Google. It had the second lowest tax burden. Its operating margin, Intel's was third, and Intel's ROE has actually been trending downwards, but Xerox had the lowest ROE. All right, here's the market value measures. PE ratio, price to earnings, price to book, enterprise value over EBITDA, and the EVA, economic value added. All right, here's the numbers for them. Got the PE, price to book, EV over EBITDA. We got the economic value added as well. All right, price to earnings ratio. Investors value Google. It has the 2016 highest price to earnings ratio and is expected to have a good future growth. Google's 2016 price to earnings ratio is 28.21. The next highest ratio was Qualcomm at 21.11, followed by Oracle at 19.76. Google has had the highest price to earnings ratio in each of the last 5 years. Qualcomm's price to earnings ratio trending upwards. Oracle's PE ratio has been consistent over the past 4 years. Intel's 2016 PE ratio is 15.25. Intel's PE ratio has been consistent over the last 4 years. Xerox's PE ratio has been steadily declining though since 2013. Price to book ratio, Google has the highest 2016 price to book ratio. Google's 2016 price to book ratio was 3.94. Google has good market value relative to its historical cost. Google's price to book ratio has been consistent over the past 5 years. Oracle had the second highest price to book ratio at 3.48, followed by Intel at 2.55. Oracle's price to book ratio has declined over the past 4 years. Intel's price to book ratio has declined slightly over the past 3 years. Qualcomm's 2016 price to book ratio was 2.49, and Xerox had the lowest 2016 price to book ratio at 1.877. EV over EBITDA, Google's had the highest enterprise value over EBITDA ratio at 15.27 for 2016. Its ratio has varied over the past 5 years. Qualcomm was at 14.77, Oracle was at 11.8 for the next highest values. Qualcomm's ratio fluctuated between 9 and 11 from 2012 to 2015 and then jumped to 14.77 in 2016. Oracle has been trending upward. Intel and Xerox have each have 2016 EV over EBITDA ratios below 10. Google had by far the largest economic value added in 2016. Its EVA was $4.477 billion. Google also had the highest EVA in 2015. Google's EVA it's been good over the last 5 years. Google's 5-year low was 2012 when it had an EVA of 2.095 billion. Intel had the second highest 2016 EVA, 2.623 billion. Intel's EVA has been more volatile. Intel's EVA was at 4.324 billion in 2014, but only 155 million in 2015. Oracle's EVA is a concern since it has also declined each of the last 5 years. In 2016, Oracle's EVA was 1.792 billion. Xerox's EVA has been in the negative each of the last 5 years. Qualcomm's EVA has generally been in the decline over the last 5 years. Qualcomm had a negative EVA also of 100 million in 2016. Xerox's 2016 EVA was at negative 231.25 million. Here's some other measures we're going to use. The same thing as we use for the other ones, the free cash flow and the price to free cash flow. All right, here's our free cash flow. Google had the highest price to free cash flow ratio. Google's 2016 ratio of 21.1 showed it was in good position to generate additional revenues. Google had the highest price to free cash flow ratio of the 5 companies each of the last 5 years. Google's free cash flow ratio has varied over the past 5 years. Qualcomm had the second highest in 2016 free cash flow ratio of 19.21. It has also had its free cash flow ratios vary over the past 5 years. Qualcomm's free cash flow ratio has also varied over. Qualcomm's free cash flow ratios varied over the past 5 years. Oracle and Intel's free cash flow ratios were 15.42 and 14.08 respectively. Intel's free cash flow ratio has been consistent over the past 5 years. Oracle's free cash flow ratio has also varied over the past 5 years. Xerox ratio steadily improved over the past 5 years, but this is due to declining free cash flow. Its free cash flow ratio is 8.83, which is the lowest in 2016. Here's free cash flow. Google had 2016 free cash flow of 25.824 billion, the highest of any company. Google also had the highest 2015 free cash flow. Google's free cash flow has been increasing over the past 4 years. Intel had a 2016 free cash flow of 12.183 billion, second highest of any company. Intel's free cash flow has also steadily improved over the past 5 years. Oracle's was 12.105 billion for free cash flow, but its cash flow amounts have decreased over the past 4 years. Both Qualcomm at 4.003 billion in 2016, Xerox at 1.002 billion in 2016, have seen their free cash flow ratios seen their free cash flow numbers steadily decline over the past 5 years. Supply chain, Qualcomm received 21.81% of its revenue from Hanhai Precision and 20.7% of its revenue from Samsung Electronics. It also paid out 11.3% of its revenue to Taiwan Semiconductor, representing 37%, 85% of its cost of goods sold expense. Oracle has had a lot of its cost of goods sold purchased by Oracle Corp in Japan. Intel received 15% of its revenue from Dell and 13% from Lenovo. And Google and Xerox were not dependent really on any suppliers or buyers. Top company in the technology industry, I chose Google. Google ranked the highest in most performance measures. Google was the most financially sound company in the technology industry. The reasons Google was selected are, Google had the highest current ratio. In 2016, the current ratio was 6.29, which was by far the largest of any of the 5 companies. In the 5-year period from 12 to 16, Google's current ratio has increased every year. Also, Google also had the highest quick ratio in 2016. Google's quick ratio was 5.99, showing it was in very good position to cover its short-term obligations. Google's quick ratio has grown each from 2012 to 2016. Google had a 2016 cash ratio of 5.15, showing it was in a strong position to pay back its short-term debts. Google had the highest cash ratio of any of the 5 companies for the last 5 years. Google's cash ratio has been trending upward over the last 5 years. Here's some more stuff on Google. Google had the lowest financial leverage ratio in 2016. Google is using less debt to finance its assets than all the other companies. Google's financial leverage ratio has been very consistent for the past 5 years. It's also had the lowest financial leverage ratio of any other company over the last 5 years. Google had the highest EBITDA to interest expense ratio. It consistently had the highest EBITDA to interest expense ratio of the 5 companies over the last 5 years. Google's EBITDA to expense ratio has generally been trending upward over the last 5 years. Google had a 2016 asset to turnover ratio of 0.5732, the highest 2016 ratio amongst 5 companies. Google has had a very consistent asset to turnover ratio. Google is good at using assets to generate its sales, and the profit margin of Google has been consistent over the last 5 years as well, and it's had a consistent ROE over the last 5 years. Also had the highest ROA in 2016. Google management has been efficient at using its asset to generate earnings. Google's ROA has been consistent over the past 5 years. Here's a little more. Google had the highest 2016 price to earnings ratio. It's expected to have good future growth. Google has the highest 2016 price to book ratio. Google has the highest enterprise value EBITDA over EBITDA ratio for 2016. It has the highest EV EBITDA over EBITDA ratio of any company actually for the last 5 years. Google had by far the largest EVA in 2016 with that of 4.477 billion. Google also had the highest EVA in 2015. Google's economic value has been pretty good over the last 5 years. Google had the highest price to free cash flow ratio. Google had the highest price to free cash flow ratio of each year over the past 5 years. Google had a 2016 free cash flow ratio of 25.824 billion, the highest of any company. Google also had the highest 2015 free cash flow ratio. Google's free cash flow has been increasing over the past 4 years. All right, now we're on to the third one, the pharmaceutical industry. We're going to go Merck Incorporated, Pfizer, Johnson & Johnson, Bristol Myers Squibb, and Cardinal Health Incorporated. Here's a little description of each of the companies. Short-term solvency, going to use what we use for the first 2 industries, just like that. Current, the quick, and the cash ratio, and here's the numbers for those ratios for each of the 5 companies for the pharmaceutical industry. All right, Johnson & Johnson had the highest 2016 current ratio at 2.47. Johnson & Johnson's current ratio has been improving over the last 5 years. Johnson & Johnson is in good position to meet its short-term obligations. Merck had a 2016 current ratio of 1.77, second highest current ratio of the 5 companies. Merck's current ratio has varied more in the last 5 years. Bristol Myers had the 3rd highest 2016 current ratio at 1.59. Bristol Myers ratio has also varied more in the last 5 years. Cardinal Health had a 2016 current ratio of 1.33. Pfizer had a current ratio of 1.25. The quick ratio for these companies, Johnson & Johnson had the highest 2016 quick ratio with a quick ratio of 2.03. Johnson & Johnson's quick ratio has steadily grown over the last 5 years. Merck's 2016 quick ratio of 1.24 was the second highest quick ratio, followed by Bristol Myers at 1.14. Merck's quick ratio has varied more over the last 5 years. Bristol Myers' quick ratio has generally improved over the last 5 years. Pfizer's quick ratio was 0.83 in 2016, and its ratio has been declining over the last 5 years. And Cardinal, their quick ratio is at 0.7. It did not exceed. And its quick ratio never exceeded 0.646 in the years from 2012 to 2015. All right, Johnson & Johnson had the highest cash ratio with a 2016 ratio of 1.59. This is a good indication that Johnson & Johnson can meet its short-term obligations. Johnson & Johnson's cash ratio has grown each year over the last 5 years. The other 4 companies each had cash ratios below 1. Merck had the second highest cash ratio at 0.83, followed by Bristol Myers at 0.71. The cash ratios for Merck and Bristol have varied more over the last 5 years as compared to Johnson & Johnson. Pfizer had a 2016 ratio of 0.56. Cardinal had the low 2016 cash ratio, actually, 0.32. Pfizer's cash ratio has dropped significantly, actually, over the last 3 years. All right, based on analysis of liquidity ratios, Johnson & Johnson was in the best position to meet its short-term obligations. Merck was second, followed by Bristol Myers. Johnson & Johnson had the highest 2016 quick and cash ratio. Further, Johnson & Johnson's current ratio and quick ratio and cash ratio have been increasing over the last 5 years. Long-term solvency. In analyzing long-term solvency, we're going to use the same ratios we used before, the financial leverage ratio and the cash coverage ratio. Here we go. It's the numbers for each of the 5 companies. Johnson & Johnson had the lowest financial leverage ratio in each of the past 5 years. 2016, the ratio was 1.93. Johnson & Johnson is using less debt than other companies to finance its assets than the other companies. Bristol Myers had the second lowest 2016 financial leverage ratio at 2.15, followed by Merck at 2.32. Bristol Myers' financial leverage ratio has been declining over the last 5 years. Merck's financial leverage ratio has been increasing over the last 5 years. Pfizer's financial leverage ratio has increased from 2012 of 2.28 to a 2016 financial leverage ratio of 2.72. Cardinal Health had a high 2016 financial leverage ratio at 5.55. Cardinal Health's financial leverage ratio has been steadily increasing over the last 5 years as it is increased use of its debt. Johnson & Johnson had the highest EBITDA to expense ratio. Its ratio in 2016 was 34.38. Johnson & Johnson's cash coverage ratio exceeds 34 in each of the last 5 years, actually. Johnson & Johnson also had the highest cash coverage ratio of any company in each of the last 5 years. Bristol Myers coming in second in 2016 at 31.47, which by far exceeds its 2015 ratio, which was at 13.98. Merck had a 2016 ratio of 15.61, followed by Pfizer at 14.97. Merck's cash coverage ratio has been generally decreasing over the last 5 years. Pfizer's cash coverage ratio over the last 5 years has been consistent with its 2016 number. All right, Johnson & Johnson's clearly the strongest position to meet its long-term obligations. It had the lowest 2016 financial leverage ratio, and it had in 2016 and it also had the lowest financial leverage ratio of any company in each of the last 5 years. Johnson & Johnson has been using less debt to finance its assets than any other company of these other four. Johnson & Johnson had the highest 2016 EBITDA to expense ratio of any company. Johnson & Johnson also had the highest cash coverage ratio of any company in each of the last 5 years. Bristol-Myers was second in each of these categories in 2016. While its financial leverage has been increased and it still had good financial leverage ratio and good cash coverage ratios, Bristol-Myers was second best positioned to meet its long-term obligations. Here's our asset management or asset turnover for each of the 5 companies. Look, there's the numbers. The asset turnover ratio for Cardinal Health was 3.5 in 2016. Its asset turnover ratio has exceeded 3.5 in each of the last 5 years. Cardinal Health has been efficient in using its assets to produce revenue. Its asset turnover ratio has been consistent over the past 5 years. Bristol-Myers had a 2016 ratio of 0.59. Bristol-Myers' asset turnover ratio has increased over the past 4 years. Johnson & Johnson's asset turnover ratio was 0.52. Johnson & Johnson consistently had an asset turnover ratio that exceeded 0.52 over the last 5 years through its asset turnover ratio, which has been slightly declining over the last 5 years. Merck had a 2016 ratio for asset turnover ratio of 0.4 and Pfizer's asset turnover ratio of 0.31. It's been consistent with its numbers over the past 5 years. Pfizer has. Profitability, going to use what we use for the other 2 industries, profit margin, ROE, and the DuPont. And here's the numbers for them from the Bloomsburg. Johnson & Johnson's profit margin in 2016 was 23. Johnson & Johnson's profit margin has steadily grown over the last 5 years from a profit margin of 16.14 in 2012 to 23 in 2016. Johnson & Johnson has been effective at converting sales into profits. Bristol-Myers had a profit margin of 22.94 for 2016. However, this greatly exceeded its 2015 profit margin of 9.45. Bristol-Myers' profit margin was out of line with its previous profit margins over the last 5 years. Cardinal Health had the lowest profit margin of 0.99 in 2016. Its highest profit margin, though, was in 2013 at 1.28, but it's still very low. Pfizer's profit margin has declined over the past 4 years. Pfizer's 2016 profit margin was 13.65. Merck had a profit margin of 9.25 in 2016. Merck's profit margin has been erratic over the past 5 years also. The ROE, return on equity for Bristol-Myers, it had the highest in 2016 at 29.28. It exceeded its 10.75 by a lot in 2015. It was 10.75, but it jumped up to 29.28 in 2016. Bristol-Myers had the next highest ROE over the last 5 years. Its ROE was 17.81 in 2013. Johnson & Johnson had the second highest for 2016 though in ROE at 23.37. However, Johnson & Johnson has been much more consistent with its ROE over the past 5 years than Bristol-Myers, even though Bristol-Myers had the next highest then. Johnson & Johnson's ROE has steadily increased over the last 5 years. In 2012, it was at 17.81, and then in 2016, it rose to 23.37. Cardinal Health had an ROE of 19.18, which has been consistent with its performance over the last 4 years. Pfizer and Merck's ROEs were lower for 2016 for both companies at at 11.61 for Pfizer and Merck at 9.25. All right, return on assets. Bristol Myers had the highest ROA in 2016 at 13.61. Johnson & Johnson's 2016 ROA was 12.04. However, Bristol Myers' 2016 ROA was far above any of its ROA for the preceding 5 years. For example, in 2015, Bristol Myers' ROA was at 4.77. Comparatively, Johnson & Johnson has been very consistent it's efficiently managing its assets to generate earnings over the past 5 years. It's also had the highest ROA of any of the 5 companies in each of the last 5 years, except for Bristol in 2016. The 2016 ROAs for Pfizer, Merck, and Cardinal were 4.25, 3.97, and 3.47. All right, here's the DuPont. All right, Bristol Myers had the largest 2016 adjusted ROE at 30.23. This was Bristol Myers' highest ROE over the last 5 years. Notably, Bristol Myers' financial leverage ratio has been declining, so increased financial leverage was not the reason why its ROE increased. Rather, Bristol's operating margin has been increasing. Bristol Myers' operating margin has significantly jumped in 2016, and this was the primary reason for its jump in ROE. Bristol Myers also had the lowest interest burden of any of the 5 companies. Bristol Myers' interest burden generally decreased over the past 5 years, but not significantly. Bristol Myers' asset to turnover has risen steadily over the last 4 years. Bristol Myers has had has the highest asset turnover ratio of any company other than Cardinal Health. The low interest burden and high asset turnover also contribute to its high ROE. We're continuing. Johnson & Johnson had an ROE of 24.61 in 2016. Its ROE has been pretty consistent over the last 5 years. Johnson & Johnson has the highest operating margin of any of the 5 companies. It uses less financial leverage for its operation than any of the other companies we're looking at. Its financial leverage ratio has increased somewhat over the last 4 years, but it's lower than any other company. Johnson & Johnson has a low interest burden, and its ROE is due to its low interest burden, low tax burden. Its high operating margin have definitely contributed to having the second highest 2016 ROE of any of the 5. Cardinal Health's ROE in 2016 was at 21.78. Cardinal has a high tax burden. Its tax burden has grown over the last 3 years. Has low operating margin, the lowest of the 5 companies. Cardinal uses a lot of debt to finance its assets, and it had a very high 2016 financial leverage ratio, which in 2016 was at 5.55. It's increased over the last 5 years, each year. And Cardinal Health also had a high asset turnover ratio. Cardinal Health's ROE is due to its very high financial leverage ratio and its high asset turnover ratio. Pfizer and Merck had lower adjusted ROEs at 18.35 and 13.68 for 2016. Both had financial leverage ratios higher than Johnson & Johnson, but had lower asset turnover ratios and lower operating margins than Johnson & Johnson. Here's the market value. We're looking at the PE, price to book, and EV over EBITDA, and we're also looking at the EVA. Merck had the highest PE ratio in 2016, which was at 28.25. It's been erratic. In 2015, it was actually only 14.71. Bristol Myers' PE ratio was 21.36, followed by Johnson & Johnson at 18.44. Pfizer at 17.57, and Cardinal at 17.11. Bristol Myers PE ratio was its lowest in the 4 years, which raises some concern. Johnson & Johnson's PE ratios have been steadily increased over the past 5 years. Pfizer's 2000 PE ratios represented a decline from its 2015 ratio, and Cardinal's PE ratio has steadily decreased over the last 3 years. Price to book ratio. Bristol Myers had the highest 2016 price to book ratio of 6.01. This was the lowest ratio over the past 3 years. Johnson & Johnson's price to book has generally been trending upward. Johnson & Johnson's price to book ratio of 4.42 was its highest ratio in the past 5 years. It was also the second highest 2016 price to book ratio amongst the 5 companies. Merck's price to book ratio is at 4.03. Its ratio has steadily increased over the past 5 years. Pfizer's ratio was at 3.31 in 2016. Its ratio has also steadily increased over the past 5 years. Cardinal's price to book ratio has declined over the past 3 years. EV over EBITDA. Bristol Myers had the highest price to book ratio with a ratio of 18.16. The price to book ratio has been erratic over the past 5 years. Merck's was second highest in 2016 at 15.99. Its ratio has been generally increasing over the past 5 years. Pfizer had a 2016 ratio of 12.47. Its ratio has also been generally increasing over the past 5 years. Johnson & Johnson had a 2016 EV over EBITDA ratio of 11.99. Johnson & Johnson's EV over EBITDA ratio has been fairly consistent over the last 5 years. Cardinal Health's ratio was at 9.96, and its EV over EBITDA ratio steadily declined over the past 5 years. Economic value added. Johnson & Johnson's EVA was at 9.031 billion, which was by far the largest EVA of any of the 5 companies. Pfizer had an EVA of 4.398 billion, followed by Bristol at 1.718 billion. Johnson & Johnson had the highest EVA added in each of the last 5 years. Pfizer's economic value added numbers have been erratic over the past 5 years. Pfizer had a very large EVA in 2012 and a negative EVA actually in 2014. Bristol Myers EVA has also been erratic over the last 5 years. Both Merck was at negative 2.633 billion, and Cardinal Health was at negative 41 billion. They were at negative for the EVA, economic value added. Here's some other measures we're looking at: the price to free cash flow, Bristol Myers had a price to free cash flow ratio of 59.72 for 2016, the highest of any company. Bristol Myers' price to free cash flow ratio has been very erratic over the past 5 years, though. Cardinal Health's price to free cash flow ratio was at 30.99 in 2016, which far exceeds its price to free cash flow ratio of any of the previous 4 years. 2015, its price to free cash flow ratio, for example, was only at 10.17. Part of the explanation for Cardinal Health's high 2016 price to free cash flow ratio was significant. It was the significant drop in free cash flow between 2015 and 2016. Johnson & Johnson had a price to free cash flow ratio of 20.29. Its price to free cash flow ratio has been fairly consistent over the past 5 years. Pfizer's price to free cash flow ratio was at 14.04. Merck's price to free cash flow ratio was at 18.58 for 2016. The free cash flow, Johnson & Johnson had the highest free cash flow of any company in 2016, which was at 15.541 billion in 2016. Johnson & Johnson also had the highest free cash flow ratio in 2015 as well. Pfizer had a free cash flow ratio of 14.078 billion in 2016. Merck's in 2016 was at 8.762 billion. Bristol Myers in 2016 was at 1.635 billion. And Bristol Myers 2016 free cash flow was its lowest free cash flow in the past 5 years. Cardinal Health's free cash flow ratio dropped from a free cash flow of 2.506 billion in 2015 to only 797 million in 2016. The pharmaceutical companies were more reliant on a couple larger buyers than companies from the technology or entertainment industry. Cardinal received 23% of its revenue from CVS Health Corporation and 11% of its revenue from United Health Group. Bristol Myers received 22% of its revenue from McKesson Corporation and 18% from AmerisourceBergen. And Pfizer received 16% of its revenue also from McKesson Corporation and 12% of its revenue from AmerisourceBergen. Johnson & Johnson and Merck were not really dependent on any one buyer. All right, so the top company for the pharmaceutical industry, I chose Johnson & Johnson. Johnson & Johnson had the highest 2016 current ratio. Its current ratio has been improving over the past 5 years, and it's in good position to meet its short-term obligations. Also had the highest 2016 quick ratio. The quick ratio has steadily grown over the last 5 years. Had the highest cash ratio as well. It's another good indication that it can meet its short-term obligations. Johnson & Johnson's cash ratio has grown each over the last 5 years. Had the lowest financial leverage ratio of the past 5 years. It's using less debt than other companies to finance its assets. It had the highest EBITDA to interest expense ratio in 2016, which was 34.38, exceeding 34 in each of the last 5 years. And it has exceeded 34 in each of the last 5 years. Johnson & Johnson has also had the highest cash coverage ratio of any company in each of the last 5 years. Continuing with Johnson & Johnson, our profit margin in 2016 was 23, the highest of any of the 5 companies. And its profit margin has also steadily grown over the past 5 years. It's been efficient at converting the sales and the profits. Also had the second highest 2016 ROE at 23.37. However, it is much more consistent performance than Bristol Myers, who actually had the highest ROE, but Johnson & Johnson's been more consistent. Its ROE for Johnson & Johnson steadily increased over the last 5 years. In 2016, Johnson & Johnson had an ROA of 12.04, which was the second highest in 2016. Johnson & Johnson's been very consistent in effectively managing its assets over the past 5 years. Johnson & Johnson is not depending on any major supplier or any buyer. Johnson & Johnson has the highest free cash flow of any company in 2016. And in 2016, its free cash flow was at $15.541. And it also had the highest free cash flow actually of any company in 2015 as well. All right, so here are the top 3 companies I chose. I chose Walt Disney, I chose Google, and I chose Johnson & Johnson. So I did the same thing, current, cash, quick ratios for each of them. I compared them. Here's the numbers for you. Google had the highest current ratio, highest quick ratio, highest cash ratio for each year over the past 5 years from 12 to 16. Google's current ratio was at 6.29 for 2016. Johnson & Johnson had a 2016 current ratio of 2.47. Disney's had a current ratio of 1. Google had a 2016 quick ratio of 5.99 compared to 2.03 for Johnson & Johnson and 0.77 for Disney. Google's current ratio, its quick ratio, and cash coverage ratio have each been trending upwards. Google was in the best position to meet its short-term obligations. Here's the long-term solvency for each of the 3 companies. All right, Google uses the least debt to finance its assets. Google has had the lowest 2016 financial leverage ratio of the 3 companies. Google also had the lowest financial leverage ratio in each of the past 5 years of them. Johnson & Johnson and Disney were close to each other in financial leverage ratio numbers. Google also had the highest EBITDA to interest expense. Google's 2016 EBITDA to interest expense was at 240.8. Google's cash coverage ratio has been trending up, where Disney had a cash coverage ratio of 47/35. Johnson & Johnson had a cash coverage ratio of 34.28, 47.35, 34.28. Google has the strongest long-term solvency position. And here we're looking at the asset turnover for my top three. All three companies, they have pretty comparable asset to turnover ratios. All three companies, they show good management in using their assets to generate sales. 2016, the asset turnover ratio for the companies in order from high to low is Disney at 0.61, Google next at 0.573, and Johnson & Johnson at 0.523. All three companies had asset to turnover ratios over a 5-year period that were consistent with their 2016 ratio. All right, looking at the ROE, the profit margin for our top three companies. Johnson & Johnson had the highest 2016 profit margin, the profit margin of the three companies for 2016. In order from high to low, were Johnson & Johnson at 23.007, Google at 21.577, Disney at 16.88. Johnson & Johnson's profit margin has steadily grown over the last 5 years. Google and Disney's profit margin over the last 5 years have been consistent with the 2016 number. The ROE for Johnson & Johnson had the highest ROE for 2016. The ROE of the three companies in order from highest to low, Johnson & Johnson was at 23.37, Disney at 21.39, Google at 15.02. Google's ROE has been consistent. The ROE of Disney has grown over the past 4 years. The ROE of Johnson & Johnson has generally grown over the past 5 years. And Johnson & Johnson had the highest ROE in each of the past 5 years. For return on assets, Google had the highest 2016 return on assets. The ROA was at 12.36. Johnson & Johnson had the second highest at 12.05. Disney had a third highest at 10.42. Google and Johnson have had consistent ROAs over the past 5 years, and Disney's ROA has been trending upwards. Here's the DuPont for the three companies. All three companies have low interest burden. Disney had a higher interest burden than Google or Johnson & Johnson. Johnson & Johnson has the highest ROE. Johnson & Johnson had the lowest operating margin, had the second highest financial leverage ratio, and the lowest tax burden, which helps explain its high ROE. Disney had the second highest ROE. Disney had the highest financial leverage ratio. Disney had the highest asset to turnover ratio. Disney had the highest tax burden of any of the three companies. Disney's ROE position is attributed to its high financial leverage ratio, its asset turnover ratio, and its low interest burden. Google had the second highest asset to turnover ratio. Google had a low interest burden and a low tax burden. Google's low financial leverage was primarily the reason its ROE was lower than that of the other two companies. Here's the market value measures: PE ratio, price to book, EV over EBITDA, and our EVA. Google had the highest price to earnings ratio. Investors had a higher willingness to pay for Google stock per dollar of its earnings. Google had a 2016 PE ratio of 28.21. Johnson & Johnson was second highest of the PE ratio, which was at 18.44. Disney coming in third at 16.23. Google's price to earnings ratio was the highest ratio in each of the last 5 years. Johnson & Johnson saw its price to earnings ratio steadily rise over the last 5 years as well. Price to book ratio, Johnson & Johnson had the highest price to book ratio in 2016. Its 2016 price to book ratio was 4.42. Its price to book ratio has generally been rising. Google had had the second highest price to book ratio, which was at 3.94 in 2016. And Google and Disney's price to book ratios have been pretty consistent over the past 5 years. EV over EBITDA, Google had the highest EV over EBITDA. The EV over EBITDA ratio for the three companies in 2016 from high to low were Google at 15.27, Johnson & Johnson 11.98, Disney at 10.09. Google had the highest EV to over EBITDA ratio in each of the last 5 years. Disney and Johnson & Johnson have had consistent price to book ratios over the past 4. EVA. All companies had good economic value added. All three made economic profit. Johnson & Johnson had the largest in 2016. Johnson & Johnson's EVA was $9.031 billion in 2016. Google came in second at $4.447 billion. Disney coming third at $2.143 billion. Johnson & Johnson had the highest EVA in each of the last 5 years. Other measures, price to free cash flow and our free cash flow. Google also had the highest 2016 price to free cash flow ratio. Google's price to free cash flow ratio is at 21.05. Johnson & Johnson's was at 20.29. Google had the highest ratio for this of each of the last 5 years. For free cash flow, Google was at $25.824 billion. This was the highest of any company. Johnson & Johnson was next at $15.541 billion. Disney followed by $8.44 billion. Google and Disney saw their free cash flows grow over the past 5 years, but Johnson & Johnson, it's just been pretty consistent. Supply chain, none of these companies were dependent on any one buyer, and none of these companies were dependent on any one seller. Top company, all three companies were good. They were financially sound. I chose Google. The reason I chose Google had the highest current ratio, highest quick ratio, highest cash ratio for each of the past 5 years. Google was in the best position to meet its short-term obligation. It uses the least debt to finance its assets, has the lowest financial leverage ratio, also has the highest EBITDA to expense, and is best positioned to meet its interest expense. Google has the strongest long-term solvency position. Google's asset to turnover ratio is comparable to other companies. Google had a consistent asset turnover ratio over the last 5 years. Google had a good 2016 profit margin. Google's 2016 profit margin has been consistent over the past 5 years. Google had the highest ROA in 2016. Its ROA has been consistent over a 5-year period. Google had the highest price to earnings ratio. Google's price to earnings ratio was the highest ratio in each of the last 5 years. Google had the highest EV over EBITDA ratio. It also had the highest for that ratio, the EV over EBITDA for each of the last 5 years. Google had the highest price to free cash flow ratio in 2016, which was at $25.824 billion. Google's free cash flow has grown over the past 4 years. So I choose Google.